Welcome to Wealth Wisdom. In this video, we are going to look at portfolio diversification. In the realm of wealth management, portfolio diversification stands as a cornerstone strategy that investors utilize to mitigate risk and enhance potential returns. The principle behind diversification is straightforward. By spreading investments across a variety of assets, an investor can reduce the impact of any single asset's poor performance on the overall portfolio. This video delves into the intricacies of portfolio diversification, exploring its benefits, strategies, challenges, and the future of portfolio diversification. Understanding portfolio diversification. Portfolio diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale is that a diversified portfolio will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification limits portfolio risk because asset classes often react differently to the same economic event. For instance, while equities might perform poorly during a recession, bonds or precious metals might hold their value or even appreciate. Types of diversification. Diversification can be achieved at various levels and through multiple approaches. 1. Asset class diversification. This involves spreading investments across different asset classes such as equities, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, which helps balance the overall portfolio. 2. Geographic diversification. Investing in different regions or countries can protect against regional economic downturns. Global diversification reduces exposure to risks associated with any single economy. 3. Sector diversification. Within the equity portion of a portfolio, investors can diversify across different industries or sectors, such as technology, healthcare, finance, and consumer goods. Each sector reacts differently to economic changes. 4. Investment style diversification. Combining various investment styles, such as growth, value, and income, can enhance diversification. Growth stocks tend to perform well during economic expansions, while value stocks might offer more stability during downturns. 5. Currency diversification. For investors with international exposure, currency diversification can mitigate the risk of currency fluctuations. Holding assets denominated in various currencies can reduce the impact of adverse movements in any single currency. Benefits of portfolio diversification. The primary advantage of diversification is risk reduction. By holding a mix of assets, investors can smooth out the volatility of their portfolios. Here are some specific benefits. 1. Reduction of non-systematic risk. Non-systematic risk, also known as specific risk, pertains to individual investments. Diversification reduces this risk because the poor performance of one asset can be offset by the better performance of others. 2. Enhanced risk-adjusted returns. Diversification helps achieve a more favorable risk-return trade-off. Investors can attain similar returns with lower risk or higher returns for a given level of risk. 3. Mitigation of emotional investment decisions. A diversified portfolio can help investors avoid making impulsive decisions based on short-term market fluctuations. With a well-diversified portfolio, investors are less likely to panic during market downturns. 4. Access to growth opportunities. Diversification allows investors to participate in the growth of various sectors, regions, and asset classes. This broad exposure can enhance overall portfolio performance. Strategies for effective diversification. Creating a diversified portfolio requires thoughtful planning and continuous management. Here are some strategies to consider. First, identify financial goals and risk tolerance. The first step in diversification is understanding your financial objectives and risk tolerance. This helps in determining the appropriate asset allocation. Second, asset allocation. This is the process of dividing an investment portfolio among different asset categories. The allocation should align with your investment goals, risk tolerance, and investment horizon. Third, regular rebalancing. Over time, the performance of different assets will cause the portfolio to drift from its original allocation. Regular rebalancing ensures that the portfolio stays aligned with your risk tolerance and investment objectives. Fourth, incorporate alternative investments, including alternative investments like private equity, hedge funds, and real estate can provide additional diversification benefits, as these assets often have low correlations with traditional asset classes. Fifth, use of mutual funds and ETFs. Mutual funds and exchange-traded funds, or ETFs, offer instant diversification within a single investment. These funds pool money from multiple investors to buy a diversified portfolio of assets. Sixth, consider dividend reinvestment. Reinvesting dividends can enhance the compounding effect and contribute to portfolio growth over time. Finally, stay informed. Keeping abreast of market trends and economic indicators can help in making informed investment decisions. Challenges of diversification. While diversification is a powerful tool, it is not without challenges. First, there's over-diversification. Too much diversification can lead to diminished returns. Holding too many assets can result in a portfolio that mimics the market index, reducing the potential for outperformance. Next, complexity and costs. Managing a diversified portfolio can be complex and costly, especially when investing in international markets or alternative assets. Transaction costs, management fees, and taxes can erode returns. Then, correlation breakdown. During extreme market conditions, correlations between asset classes can increase, reducing the effectiveness of diversification. This was evident during the 2008 financial crisis when many supposedly uncorrelated assets moved downward simultaneously. Finally, changing market dynamics. The investment landscape is constantly evolving. What worked as a diversification strategy in the past might not be effective in the future. Continuous monitoring and adjustment are necessary. Case studies in diversification. To illustrate the importance of diversification, let's consider a few real-world examples. First, the dot-com bubble. In the late 1990s, many investors were heavily concentrated in technology stocks. When the bubble burst in 2000, these investors suffered significant losses. Those with diversified portfolios, including bonds and non-tech stocks, fared much better. Next, the 2008 financial crisis. Diversification was put to the test during the 2008 financial crisis. While most asset classes experienced declines, portfolios with a mix of stocks, bonds, and commodities were better able to weather the storm compared to those heavily concentrated in equities. Lastly, the post-COVID-19 recovery. The COVID-19 pandemic led to unprecedented market volatility. Diversified portfolios that included technology, healthcare, and stay-at-home stocks recovered faster than those concentrated in traditional industries like travel and hospitality. The future of diversification. As the investment landscape evolves, so too must diversification strategies. Here are some emerging trends. First, ESG investing. Environmental, social, and governance factors are becoming increasingly important. Integrating ESG criteria into investment decisions can provide diversification benefits and align investments with personal values. Next, technological advancements. The rise of robo-advisors and advanced analytics has made it easier for investors to construct and manage diversified portfolios. These tools can offer personalized advice and automated rebalancing. Then, globalization. Continued globalization opens up new opportunities for geographic diversification. Emerging markets, in particular, offer growth potential that can enhance portfolio returns. Also, alternative assets. Increasing interest in alternative assets such as cryptocurrencies, private equity, and real assets provides additional avenues for diversification. These assets often exhibit low correlations with traditional asset classes. Finally, behavioral finance. Understanding the psychological factors that influence investment decisions can help in designing more effective diversification strategies. Behavioral finance insights can aid in avoiding common pitfalls like overconfidence and herd behavior. Conclusion. Portfolio diversification remains a fundamental principle of effective wealth management. By spreading investments across various asset classes, sectors, and geographies, investors can mitigate risk and enhance potential returns. While diversification does not guarantee against loss, it is a powerful tool for achieving long-term financial goals. As the financial landscape continues to evolve, so too must diversification strategies. Investors must stay informed, be adaptable, and continuously reassess their portfolios to navigate the complexities of the global markets. Embracing diversification is not just about managing risk, it's about seizing opportunities in an ever-changing investment environment. Whether you're a novice investor or an experienced one, understanding and implementing diversification can pave the way for a more secure financial future. If you have enjoyed this content, please hit the notification button and subscribe for more content like this every week. Stay blessed.